Hello class, I've put together a PowerPoint presentation for you on how to avoid credit card debt. Credit cards can be a wonderful aid to help you in times of financial trouble, but they can also put you in serious debt if you're not careful. Please click on each slide included in this presentation and listen to the audio attached so you'll be better prepared to handle a credit card once you decide it's time to get one. That getting a credit card when you're financially ready for one is a good thing. It can help you to establish good credit, which will boost your credit score. A good credit score allows you to take out a loan for big items such as a car or a house or for something unforeseeable in the future. A bad credit score, however, can prevent banks and lenders from taking a chance on you. Be sure to only use the credit card with purchases you can easily pay back right away so that you do not fall into financial ruin. Having too much debt can also prevent you from reaching your financial goals. Let's imagine that you are saving for a trip with a friend. The cost of the hotel, air travel, and funds for leisure activities may run you close to a couple $1,000s. If you owe too much money on your credit card, it'll become impossible to save for the trip. What's worse is, some of you may elect to put the cost of the trip on the credit card, and this will accrue more debt. If you decide to purchase clothes or other items for the vacation, this will also add up, even if they seem like small, manageable purchases. The more you use your card for items that are more of a want and not a need, the more your debt will accrue. Think back to a lesson from earlier in this course when we weighed the difference between a want and a need. Sometimes credit cards allow us to make impulse buys that are more of a want than a need. Do your best to only use credit card for an absolute need. It's imperative that you only use the credit card for purchases that can be easily paid back right away so that you do not run the risk of falling into debt. Debt will catch up with you very quickly. Think about how often you use your parents' credit cards for Ubers or ordering food online. These small food purchases come with small fees that add up, right? Well, you'll find that these small hidden fees tacked on to what seems like a reasonable purchase adds up so much so quickly that the debt becomes difficult to pay off, especially when you're using your money to purchase other things for fun throughout the week. Lastly, using a credit card, if you're not careful, can result in thousands of dollars of interest payments. Not sure what interest is? Click on the next slide to listen and find out how interest affects you. An interest rate is the percentage of principal charged by a lender for the use of its money. The principal is the amount of money loaned. So in other words, when you borrow money, lenders demand that you pay them for their risk. They don't know if you'll be able to repay the loan, so they want compensation. In the end, it'll cost you more than the cost of the item that you purchased with the credit card to simply use the card once. Interest is the bank's way of not only making sure that they're making money back in the end, but that they also make a profit. Keep in mind, they're taking a risk lending you money. Imagine you ask a friend in the cafeteria to borrow $5 for lunch. They agree to lend it to you, but they say, if I give you 5 today, I want 7 back by the end of next week. A scenario like that might cause you to say, this isn't worth it. And if that's the case, then you know the purchase you were about to make is more of a want than a need, and you should walk away from that offer. But what if you were starving and really needed the food? In that case, you would gladly pay your friend $7 by the end of the next week for $5 today. Banks operate the same way. They want to make money off the act of lending you money. When dealing with a credit card, your mindset should be one that is able to assess, in that moment, if borrowing money with an attached interest rate is really worth it. So, you decided to open up a line of credit, which is a good idea. Most young people do, especially because if you don't have enough in your savings, a credit card may be your only option to save you from a major car repair or a medical bill or some other unexpected expense. So if you decide to open up a line of credit or you decide to take out a credit card with your bank, here are some ways to avoid debt and falling into financial ruin. Okay, tip number one, build a safety net. At your age, you should really be putting away a little bit of money each week. Even if it's just a couple dollars here and there, you should start saving money immediately. If you have a full-time job, that's great. If you have a part-time job, just as good. But if you don't have a job at all and you're receiving money from mom and dad, or you're doing small chores around the house to earn money once in a while, this is the right time to put a portion of that money away. It's important to save money so that in the future you will have money to pay off debt because eventually you are going to take out a line of credit. Eventually you are going to use a credit card. And that's fine, as we discussed before, but it's important that you have some money tucked away so that you can pay the balance off right away. When it comes time to make a credit card purchase, remember, you are also not just paying for the amount of the item you try to purchase, but there is the interest rate that is attached to it. You are paying back more than what you actually used to make the purchase. The longer you put off paying back your debt, the higher that balance becomes. So you do not want it to get to the point where you find yourself in financial ruin because you've delayed paying off the balance. Imagine how quickly the blocks stack up in the game of Tetris. At first, a few seem like no big deal, but as the blocks stack up, they fall faster and faster until the point at which it's too much and then it's game over. Debt can work the same way. So you want to always pay off your balance as soon as you can. And a great way to do that is by using money that you have saved. Tip number 2, stick with what you can afford. When you leave high school, one way or another, the credit card companies will find you. They'll send you clever letters or interesting emails, but most likely they will set up a table somewhere on the commons of a college campus, maybe in the cafeteria, giving away free t-shirts, free coffee mugs, free anything, just as long as they can keep you at the table long enough to make a quick pitch to you about why you should sign up with their credit card company. They will use tricks such as a low interest rate to make their offer seem more enticing. But this is where I would remind you to read the fine print. These credit card companies do mean what they say. At first, it will be a very low interest rate, but only at first. Make sure you read the fine print to see how long that low or reasonable interest rate lasts. They know that college kids, young people, are often financially irresponsible, that you make reckless purchases, and they want to capitalize on that. Again, credit cards that have reasonable interest rates can be a wonderful thing. They allow you to make purchases normally you wouldn't be able to make at your young age. But do not give the credit card companies the satisfaction of successfully taking advantage of you and the impulse buying that typically plagues young people. You must prove to yourself that you can use the credit card responsibly. Only make purchases that are a need. Now, it's not to say that you can't use it for larger purchases that can be fun, such as a vacation or a concert or maybe a new pair of sneakers, but only do so if you know that you'll be able to pay the balance off in 1 or 2 payments. The sooner, the better. By only using a credit card for emergencies or absolute needs, you'll find it easier to avoid the pitfalls of having a credit card at a young age. Tip number 3, always pay on time. Once you miss a payment, your next payment due will be much higher since you will have to make 2 payments plus a late fee. The credit card payments will be low at first. These companies will only ask for $20 or $25 at a time. You may say to yourself, I don't have to worry about this, it's only $20 and I'll pay them next month when I have the money. Or for the next 3 weeks, you may feel like you have put off a financial annoyance, but the truth is that you are creating more problems for yourself in the future. Not only are you accruing more debt, but you are setting yourself up for failure. By failing to pay back the credit card company, you are making yourself seem like more of a risk, and this will affect your credit score. Remember, you want to keep a healthy, strong credit score for larger purchases in the future as an adult, and paying your credit card balance off on time allows you to do so. Think about how annoyed you would be with a friend if he or she did not pay you back when they said they would. Wouldn't it make you less likely to want to lend them money in the future? Wouldn't it make it so that you would have to charge them more to borrow from you because they're such a risk and you know they're irresponsible? Credit card companies act the same way. They assess risk on your spending habits. But paying on time will allow you to maintain a healthy credit score and stay financially stable. Tip 4. Know the signs of credit card debt. You should always try to pay your debt in full, but that's not always an option for everybody. If you notice your credit card balance is too high to pay in full, it's a sign that you've been charging it too much. Curbing your spending until you've paid off the balance will prevent you from making your debt worse. A good way to alleviate this burden is to tap into your savings and pay off some or all of the debt. Another sign that you are nearing debt that is too much to handle is when the amount you owe monthly is much higher than it was before. As you add to the debt on your credit card, you will notice that the monthly amount you owe has gone up as well. This is a sign that your debt is getting too high. You want to keep the amount as low as possible and pay off more than what is asked. Remember, the credit card companies are not in this to be kind. They are not lending you money to be generous. They are a company and they're in it to make money. Thanks to the interest attached to your loan, if you only pay the amount asked each month, then you will find yourself paying the company much longer and more than necessary. I've attached a chart in slide 10 to help illustrate this point. Notice that interest over a long amount of time affects how much money actually comes out of your pocket as compared to what the actual price of the item that you tried to purchase was. Always pay off more than what is asked, or as close to possibly paying it off the whole thing, so that you will remain financially stable. Tip number 5, limit the number of credit cards that you have. The more credit cards you have, the greater the opportunity to go into debt. Even if you have solid self-control, it's better not to tempt yourself with thousands of dollars in available credit. Reducing the number of credit cards in your wallet not only helps you to avoid credit card debt, it also makes it easier to manage your monthly bills. Some companies may lead you to believe that paying off one credit card with another is a clever way to reduce debt and increase your credit score. This is usually not true. If your debt is too high, credit card companies will be afraid to lend you, and they will deny extending you a line of credit. Or they will allow you to open up another line of credit, but with a much higher interest rate. The best practice is to stick to one card and use it responsibly. If you have no self-control, consider cutting up the additional credit cards that you have and paying them off as efficiently as possible. Remember, less credit cards, less problems. I hope you find these tips to be helpful for when you decide it's time to start using a credit card. For those of you who use your mom and dad's credit card for Ubers or food purchases or to buy clothes, please remember what you learned in this presentation. Small purchases today add up in the long term, so go easy on your parents' credit card. In time, you will find yourself ready to take out a line of credit. That time will most likely happen in college, but it would be best if you wait until you had a job that brings in steady income to open up a line of credit. I would recommend only using a credit card if you had to get one sooner than later to pay for college textbooks and nothing else. In an emergency situation, a credit card will serve you well. But if you're using it more for wants over needs, then you're not really using it appropriately, and you're potentially setting yourself up for a bad habit that will hurt you financially in the future. Last but not least, please start saving. It's never too early to start saving for the future. If this week of alternative schooling has taught us anything, it's that we never know what the future holds, and it's important to always have money stored away in case you're unable to work or unable to pay the bills. The time to start saving is now. Take care and enjoy the rest of your week, and I look forward to seeing you all soon.